So let me start by explaining to you what the foreign earnings exemption is all about. And as many of you will know, there was a significant change to this provision with effect from the 1st of March 2020. So this is just, the slide just illustrates some of the requirements for this exemption. So it was a tax exemption. If you were a South African employee and you worked outside South Africa for more than 183 full days in a 12-month period, which is effectively 6 months, and you had to have a continuous period that you were outside the country working, which was at least 60 days during that period, then any foreign remuneration that you earned was not subject to tax in South Africa at all. So it was a full tax exemption. If you met the requirements of the days test, you didn't pay any tax in South Africa on that foreign remuneration. Now, obviously, if you worked in South Africa and out of South Africa, you would pay a tax in South Africa on your South African-based services income, but you didn't have to pay any tax here on your foreign income, foreign remuneration. So that was a significant, obviously, saving for employees who worked outside the country. It's important to remember that, I'm just going to go to the next slide. So it was a full tax exemption. Now, the change from the 1st of March this year was that tax exempt amount was limited. Now, the current legislation refers to a limitation of 1 million rand for the tax year, but it was announced in the budget review in February this year that 1 million rand will be increased to 1.25 million, which is the figure that I've shown here. So it's expected that the legislation will be amended to create that amount as the tax exempt amount. So the result of all of this is that if you earn remuneration from working abroad and you meet the requirements in terms of the number of days that you've spent out of the country, only the first 1.25 million will be exempt from tax in South Africa. And any remuneration over and above that will become taxable here, which it previously wasn't, obviously, because the exemption was a full exemption. So this is a significant change for many South Africans who work outside the country, because obviously, you know, they would be earning dollar-based salaries potentially, or foreign currency-based salaries, and so they now may face a tax liability in South Africa, which they haven't previously had to pay. The other point is that if you work in a foreign country, you may well have tax to pay in that country. So the host country, for example, is entitled to tax you on your remuneration for services that you render in that country, and typically many countries do that. So it's important to note that the tax liability that these individuals will now suffer in South Africa will be reduced by any taxes that they've paid in the foreign country on the income that they've earned, the remuneration that they've earned. And that's referred to as a foreign tax credit. And I will come back to explaining how that works slightly later on in the presentation. But there's a South African tax liability in principle, but it will be reduced to the extent that the individual has to pay tax in a foreign jurisdiction on that same income which South Africa is now taxing. So it's just important to remember that. And I'll show you an example later on which will illustrate that point as well. So one of the sources of confusion when people have contacted us about this change in the tax exemption is that they don't fully understand who it applies to and who it doesn't apply to. So I've just summarized here some of those issues that we've come across. The exemption applies to people who are qualified as South African tax residents. So if you have an individual who has, for example, relocated to, let's say, the UK 10 or 15 years ago, and has remained there ever since, that person is not going to be tax resident in South Africa anymore. And I'll look shortly at what does it mean to be tax resident here, but that person is no longer tax resident. So this foreign earnings exemption is not applicable to them because they don't pay tax in South Africa on income from services rendered outside of South Africa. As non-residents, you're only taxed in South Africa on South African sourced income. So the first question to ask in this situation to determine whether this change in the tax exemption will apply to an individual is to ask whether they are still tax resident in South Africa. And they may or may not be, depending on their personal sort of facts and circumstances, which I will come to later. The second point to note is that this exemption doesn't apply to independent contractors. So it only applies to employees. So there needs to be an employment relationship in order for the exemption to be relevant at all. But you can be employed by a South African employer or a foreign employer, it doesn't matter. The exemption can still apply to you. And then the other point to note is that all kinds of remuneration are included in this benefit, in this exemption. So even, so including any taxable benefits that you might, fringe benefits that you might be entitled to while you're working abroad. And also share gains is another form of remuneration which is included in this exemption. In that context, it's important to note that if an item of remuneration accrues over more than one tax year, in respect of services that you rendered outside the country, there's a sort of spreading of that benefit over the tax years that it accrues, to you. So you need to, for example, in share gains, very often you'll have a vesting period of, let's say, 2 or 3 years. So the gain is then deemed to have accrued to you over that period. And this is relevant if you're partly working in South Africa and partly outside South Africa, or if you earn remuneration in 1 year and then the amount only arises in the subsequent year. You always need to consider over what period did that remuneration arise. So as I said, the foreign tax exemption is only relevant to South African tax residents. And there's a lot of confusion often as to whether somebody is still a resident of South Africa or not. So, and it depends on their personal situation. So we have a residence basis of tax, which means that South African tax residents are taxed on their worldwide income as a general principle, and non-residents, non-tax residents are only subject to tax in South Africa on their sourced income, so South African sourced income. So if we look at a person's situation, it's important to confirm whether they're still tax resident in South Africa or not. So somebody might be working abroad but remain tax resident in South Africa, or someone might be working abroad and not have remained tax resident in South Africa. And then that's an important distinction that needs to be made because the basis of tax is completely different. So what is a resident when we're looking at a natural person? So there are 2 tests for residence in our Income Tax Act. One refers to the concept of ordinary residence, which is a factual test, which I'll explain in the next slide. And the second one is a physical presence test, which looks purely at the number of days that a person has spent in South Africa effectively over 6 tax years consecutively. So it's known as the physical presence test. But there's an important exception. So a natural person who is regarded as exclusively tax resident in another country under a double tax treaty, which South Africa has with that other country, is not going to be tax resident in South Africa in terms of the Income Tax Act. So that's an important exemption or exclusion to consider where the individual is living in a country with which South Africa has a double tax treaty. And effectively what you do here is you apply the tax treaty provisions, which we refer to as the tiebreaker test, which determines whether if an individual is tax resident of both the treaty countries under each country's domestic law. So let's assume that you're a tax resident in terms of South African domestic law and in terms of the domestic law of the UK, for example, then the treaty has a tiebreaker test which determines your country of exclusive tax residence for purposes of applying that treaty. So that needs to be considered with an individual who is tax resident in a treaty country whether they are still tax resident in South Africa will depend on how one applies, how that tiebreaker test, in the treaty applies to their personal situation. So what is ordinary residence? So this is the first test for tax residency, and it's based on, as I said, on people's personal facts and circumstances. So it's what you need to do here is you need to look at the individual's personal situation. You need to look at their connections with South Africa and their personal and business connections with another country, and determine whether they are tax resident in terms of their ordinary residence. And SARS has issued an interpretation note on this, on how to do this determination, but it's very much an individual determination that you have to make. You have to look at all the factors that apply to each individual and consider whether they are ordinarily resident in South Africa or not. The fact that somebody may have left South Africa and moved to another country but has never formally immigrated for exchange control purposes is not a determinating factor in this inquiry. So it may be relevant, but it's not necessarily the case. And we find that often people have left South Africa, become tax resident elsewhere, but they've never formally immigrated. That does not make them tax resident here again. It's a factor to be considered, but it certainly isn't the only one, as you can see. And then obviously also if somebody makes regular visits to South Africa, that's also not necessarily a determining factor. You have to look at that in the context of all their personal circumstances. So if a person is working abroad, one needs to consider whether they've maintained their ordinary residence in South Africa, which might, for example, be the case, let's say their family remains here, they have kids at school, they have business and interests and investments and a property in South Africa, for example. They could very well have remained ordinarily resident in South Africa, in which case they will be tax resident here, and the foreign earnings exemption will be relevant to them. If, for example, to use my previous example, somebody left South Africa 10 or 15 years ago, moved to the UK, let's say, and has become tax resident there, then they will not be ordinarily resident in South Africa. And so the foreign earnings exemption is unlikely to be applicable to them because they're not resident anymore. So it's always important as a first step to establish, is the person tax resident in South Africa or not? And if they are, then the foreign earnings exemption will be relevant to them. If, assuming that they meet the days test, obviously they have to meet the requirements. And if they aren't, then it's not relevant to them. So I just wanted to make that distinction because there seems to be a lot of confusion around that point. The second test for residence in our Income Tax Act is physical presence, as I said earlier. And this is the test which looks at effectively it tests tax residence in the 6th tax year, and it's got to be consecutive tax years, and it looks at how many days did the person spend in South Africa during each of those 5 years and over the 5 years in total. And if you become tax resident in terms of this test, it will be with effect from the first day of year 6 that you're testing. So a person might not be intending to be resident in South Africa in terms of the ordinary residence test, but they may become tax resident here because of their physical presence, because that doesn't test your intention, for example. It just looks at how many days you spent here, regardless of why. So that's the second test for residence, but bear in mind, as I said earlier, that one always needs to consider if the individual is tax resident in a treaty country, one needs to consider the double tax treaty that South Africa has with that country to make a final determination of their residency status. So I mentioned earlier, let's assume we have an individual who is a South African tax resident and works abroad, and they qualify for the foreign earnings exemption for the first 1.25 million, but they have a balance of remuneration that is now taxable in South Africa. One of the scenarios is that they might be suffering foreign tax in respect of that amount of remuneration. And if they do, then they can claim that foreign tax that they can prove that was paid to the other country's revenue authority as a rebate against the South African tax liability that arises in respect of that foreign income, foreign remuneration that's now taxable here, with effect from the 1st of March 2020. So this is a credit which is claimed in the individual's tax return, and you need to have proof of it, of the foreign taxes that you've paid, in order to claim the exemption, the credit. Sorry. And the amount of the credit is the foreign tax that you've suffered on the amount of remuneration that's now taxable here in South Africa. So obviously, if the portion of your remuneration, the 1.25 million, is exempt from tax in South Africa, then any foreign taxes you paid on that portion will not be claimable as a tax credit. But to the extent that your remuneration exceeds 1.25 million and you've suffered foreign tax on that excess amount, you will be able to claim that against your South African tax liability in your tax return. So that's the foreign tax credit mechanism, which gives you relief against double tax. So this is just a very simple example to illustrate the points that I've been making. And it's a comparison between the tax liability for a South African resident who qualifies for the foreign earnings exemption, who qualified in 2020 tax year and who qualifies again in 2021. And this illustrates the principle that the exemption is now limited to 1.25 million. So previous in 2020 tax year, the full foreign remuneration for the year would have been exempt from tax under the previous provision. But with effect from the 1st of March 2020, which is the 2021 tax year, as I've referred to there, the exemption is limited to 1.25 million. So you will see in this example, the individual concerned will now have a taxable income in South Africa of 4 million rand, whereas last year, the taxable income would have been nil. If you do an illustrative tax calculation on the 4 million rand income, the tax liability is approximately 1.6 million. And then if you exclude, or you claim the credit, if you can claim a credit for some foreign tax that you've paid on that amount, then that's, for example, I've estimated approximately 1.4 million rand. That will reduce your South African tax liability. So obviously the numbers will depend on the individual situation, but what you see here is that instead of a nil tax liability in South Africa on the foreign employment income in 2020, the individual will now have a tax liability in South Africa in 2021. So the question then becomes, how does that tax liability get settled? And there's a couple of scenarios that are possible here. So if the individual is subject to PAYE withholding in South Africa, which they may be if they have a South African employer, for example, then they will be subject to PAYE. Their employer will subject them to PAYE on the excess amount that's taxable in South Africa over the exemption. But if they're not subject to PAYE in South Africa, then that employee will need to pay a provisional tax to SARS to account for the South African tax liability once it's been determined. And then again, there's a couple of scenarios here. One is if the employee isn't a provisional taxpayer already, in other words, by virtue of other income, let's say they've got rental income, for example. So if they're not a provisional taxpayer already, then the foreign remuneration that's now taxable here will make them a provisional taxpayer, and they will have to submit provisional tax returns and pay provisional tax to SARS. And this is where the 31st of August 2020 first provisional tax payment will have to be calculated and paid over to SARS. If the employee is already a provisional taxpayer, as I said, let's assume they've got rental income, for example, in South Africa, then the first provisional tax payment due by the 31st of August 2020 they can rely on their basic amount. So it may not have an impact now, but it will certainly have an impact at the end of February 2021. So, but the key point here is that the tax liability on the now South African taxable portion of the foreign remuneration needs to be settled as provisional tax if the employee is not subject to PAYE in South Africa, which they may well not be because they may have a foreign employer, for example. So thank you. That's my summary of the foreign earnings exemption. John T., I'm going to hand back to you now.
Jenny, thanks. And thanks very much. That was extremely detailed. Jenny, I see that there are a host of questions, and I think they will just increase as you start answering them. So what I'm thinking of doing is, if you have a look at the bottom of, if you want to have a look at the bottom of your screen, you'll see a Q&A block. I don't know if you can see it with the number 14 in red. Do you see that anywhere on your screen?
I see it, yeah. Are you talking to me? Yes.
Yes, I am. So if you can click that, and if you wouldn't mind starting at the top, there are a couple of questions, if you could read them out and address them. And at the same time, I'm going to run a poll. So to all the participants, I'm going to run a poll. If you are interested in meeting with Jenny over the next couple of weeks, please indicate so on the poll, and then Jenny will have your details and we will then contact you. So Jenny, if you wouldn't mind, while everyone's filling out the poll, if you could just go through some of those questions.
Sure, okay. So the first question is it possible to deduct from SA tax if there is no double tax treaty with that country? So the answer to that is yes, it is, because the foreign tax credit mechanism that I spoke about is in terms of our Income Tax Act. It doesn't depend on, every treaty has a double tax avoidance mechanism within it, but most countries have their own domestic legislation. So even if it's not a treaty country, the foreign tax credit, which is under Section 6 Quat of the Income Tax Act, will still apply. So in every situation, as long as you can prove that you've paid the foreign tax, you will be able to deduct it from your South African tax liability. It's limited. There are limits, you know, for example, if the South African tax is 100 and you've paid 150 in the foreign jurisdiction, then your tax credit is limited to the 100. That you would then have no tax liability here. So there are sort of requirements for the foreign tax credit to be available, but it doesn't depend on you being in a treaty country. It's a domestic law provision that applies. That's the first question. The second question. So I will be taxed on the 1.25 million offshore in country I am working in. As an SA, I will be taxed on anything above the 1.25 less whatever my offshore employer deducts as a credit. So the host country that you're working in, let me see if I understand this question correctly. The host country that you're working in has a right to tax you on the income to the extent that you, in terms of most double tax treaties anyway, and usually on a source basis, the host country that you're working in can tax you on your remuneration for services that you render in their country. So that will be the full amount. So in my example, let's say the 5.2 million, whatever I had there. So let's say I earn remuneration of 5 million and I'm working in Kenya. Kenya is entitled to tax me on that 5 million rand. So what the South African tax position, however, is that out of that 5 million rand, 1.25 million will be exempt. And in South Africa, you'll only pay tax on the excess over the 1.25 million. Your tax liability must then be calculated. And you can deduct from your South African tax that's payable on your excess remuneration over the 1.25 million, any tax that you've paid in Kenya on that 4 million or 3 point whatever it was million rand that you have to pay tax on in South Africa. So what you need to do in that scenario is you need to apportion the foreign taxes that you've paid between the taxable portion that's taxable in South Africa and the portion that's not taxable in South Africa. And then you would claim the tax credit for the foreign tax that you've paid in respect of the taxable remuneration. So I hope that that's answered that question if I've understood it correctly. Otherwise, please do ask again. The next
Jenny,
one,
so
yeah.
sorry to interrupt you, but I see that we are now at almost 25 questions. So there are a lot of questions. Let's, if you wouldn't mind continuing for the next 5 minutes, what I'll then do is I'll email you the questions from the relevant people. And then when you have time, if you could maybe contact them. But I think if we carry on like at this rate with all the questions, we'll be here all day. So maybe for the next 5 minutes, if you don't mind.
Okay, no problem. Maybe you can just interrupt me again when I'm at my 5 minutes.
I shall do that.
I'll know when to stop. Okay, so the presentation, the next question asks for a copy of the presentation, and we will provide that to the participants after the seminar, the webinar. Then the next question is, if I've lived in the USA for the last 20 years, but still SA resident, I'm not sure what the question is there. There isn't actually a question in that question. So I'm not sure, what the question is there. Is the question, is that possible? I guess it could be, but it depends on the analysis of an individual's personal situation. So it's not something that we can really just give a short answer to. And then the next question is, I've earned no income in SA and want to know if I apply for financial immigration, will my US assets be liable for CGT? Again, that's quite a complicated question. Financial immigration is exchange control immigration. So when you cease to be tax resident, which is not the same thing as financial immigration, then there is potentially a capital gains tax liability on all your assets worldwide, not just your SA assets. So I'm not sure if that's so that will be the case when you cease to be tax resident, not with financial immigration. The timing might not be the same. They might be the same, but they might not be the same. The next question, if someone has worked overseas for a number of years and complied with the time spent outside of the borders in terms of the exemption, would the individual still need to submit a tax return for the years outside of the country? Well, that then again depends on whether, firstly, whether the person is still resident in the country for tax, in South Africa for tax purposes, number one. And if so, they would have to. And number two, if the person isn't resident, then they might have to submit a tax return if they have South African sourced income. But again, it depends on what that income might be. So what is the rule with regard to someone who relocates to another country during, say, 6 months into the tax year? Well, again, it depends on why they're relocating. Is their intention in relocating to make another country their permanent home? And if so, and they cut ties with South Africa, then they will probably cease to be tax resident with effect from the date of their departure. But again, it depends on the intention and the factual situation, because relocation can be temporary or it can be permanent, and it depends on that really. Okay, then there's another question, or should I just maintain status quo? I think that needs to be dealt with in the context of perhaps the original question. So I'll address that at a later stage. A medical doctor, I think this will be the last one, Jonty. A medical doctor emigrates but keeps his practice in South Africa. He will visit South Africa in 2-week stints 5 times a year. Is he still tax resident? Okay, well, again, one needs to look at the ordinary residence test here and see whether, whether the immigration meets those factual requirements. And 5 times a year times 2 weeks, what would be 10 weeks in the year? So it will depend on whether, I think on this situation will depend on whether the person is still ordinarily resident here, in which case the number of days won't be relevant. If they've ceased to be ordinarily resident, then there will be less than the physical presence test date. So they shouldn't be tax residents in South Africa if you make those assumptions. But again, I'm making assumptions here. I just want to deal with the next one, because I think it's quite important in the current context. Please let us know how these days will be counted or treated with this lockdown still in action for more than 3 months and no international travel possible. And I just want to answer this one briefly, because it's an issue that's obviously foremost on a lot of people's minds. They haven't been able to get either back to their work, country of work, or come back to South Africa. from where they are working. So representations have been made to SARS to make some guidance available to taxpayers on this point. So at the moment, as the law stands, there is no specific provision that deals with lockdown days in this context, in the context of residence. Now, the OECD has released some guidance on this point, and has indicated that the lockdown days spent in a particular jurisdiction shouldn't create residency issues for individuals, among other aspects that they've dealt with. But SARS has still not given any guidance on this point. So, so it's difficult to say, to answer this question, whether the lockdown restrictions are going to how they're going to impact on this, on claiming this tax exemption, for example, or on the treatment of individuals when it comes to residency. Unfortunately, it's not possible to answer this question, a definitive answer, because we are still waiting for guidance from SARS on this point. Jonty, I think that's probably about all we can deal with now.
Perfect. Jenny, thank you very much, and thanks for your time. I see there are now 34 questions, so I'll contact you later today, and then we can see how you can address those questions. Thank you very much for your time. For the rest of the participants, I will, over the next 2 to 4 minutes, 5 minutes, maybe that long, take you through a couple of rules around Section 12J investments and how they work, and take you through 3 of our funds very quickly. But if you would like more information on Section 12J after hearing me out, what you can do is, and what I'll do is, if you have a look at the messaging section, I will include a link to a webinar which we host. It's now monthly, and that webinar really just educates people more around Section 12J. You can also find a link to the webinar on our website, and it's really me or one of members of my team taking you through Section 12J investments. So a quick introduction. My name is John T. Sachs. I'm a partner at Geltech. I'm also an attorney. I was at ENS Africa, Edward Nathan Sonnenberg's for 5 years, and I've been with Geltech. This is now my 6th year. At Geltech, we focus at 2 aspects in the Section 12J sector. One is we're a fund administrator. We set up Section 12J funds, also private equity funds, debt funds, alternative investment funds. But in the Section 12J market, we're one of the biggest administrators. We administer approximately 1.7 billion Rand in Section 12J funds. So effectively, if you or someone wanted to set up a Section 12J fund, we do all the administration around setting up and managing the fund. Within the Section 12J market, we're very active. We own the 12J Marketplace Conference. Pre-COVID, the conference was hosted twice a year. We have around 1,000 attendees who listen to presentations by various Section 12J funds. We own the Invest 12J website, and interestingly, we own Abacus Funding Solutions. Abacus is a lender in the Section 12J market. Effectively, if you wanted to invest, let's say, R1 million into a Section 12J fund, we would lend you up to 800,000 Rand, 80% of your investment. The only security we would need is the Section 12J shares. And as you receive your tax refund, you would pay off some of the loan, and over a period of time, even the term of the investment, you can then repay back the loan. But the nice thing about Abacus is it allows you to maximize your tax benefit. We'll also act as a fund manager. We have 3 Section 12J funds. We have a number of funds, and we currently administer, or our assets under management is around 1.1 billion Rand. I'm going to be taking you through the rules in Section 12J from an investor's perspective. I'm not going deep into the rules around what a fund manager needs to comply with. You're welcome to attend our other webinar on that. But firstly, what is Section 12J? Section 12J is a section of the Income Tax Act. It was introduced in 2009 and really failed to gain any traction until around 2015. In 2015 or pre-2015, there were various amendments to Section 12J, which resulted in a lot of interest from high net worth individuals and investors. But effectively, the tax incentive was introduced to create equity funding to SMEs, not debt funding, but equity funding. And the incentive for investors is a tax benefit. If you invest into a Section 12J fund, there are certain tax benefits, and I'll talk you through them in a moment. But effectively, to give you a visual representation of the structure, what happens is on the top level, as you can see on the screen, we have investors, which are individuals, companies, and trusts. And for today's presentation, this includes expats. They invest into a fund, which is a company, Section 12J fund or investment, and they become shareholders. They use the share certificates to prove to SARS that they made a Section 12J investment within their financial year, and that allows them to claim the tax deduction. What then happens is the Section 12J fund manages the capital and invests it into various investee companies dependent on its mandate. In the Section 12J market, there are over 188 Section 12J funds with various mandates, so investors are spoiled for choice. How does the tax deduction work? I think before I explain this, many Section 12J funds historically were guilty of punting or promoting the tax benefit as opposed to the underlying investment, because all Section 12J funds offer the same tax benefit. Unfortunately, not all of them offer the same type of returns. So how does the tax benefit work? You invest into a Section 12J fund. Within that year of investment, you receive your, you are able to deduct the amount against your taxable income. So it's upfront, it's claimed in your financial year, but up until July last year, you could invest any amount into a Section 12J fund. And now you're limited as an individual and a trust to 2.5 million Rand per year. So that's the amount you can deduct against your taxable income, 2.5 million, and for corporates, 5 million. The cap was introduced because Treasury was of the view that they need to protect the fiscus. There were some investors investing over 100 million Rand per year in order not to pay tax. So Treasury wanted to protect the fiscus, and they introduced this cap, unfortunately. How does it work? How does the tax deduction work? Well, here's a visual representation. If you have a look at the middle column, this middle column is an example where an individual elects not to make a Section 12J investment. This is an expat. Income earned abroad is 3.75 million Rand. The exclusion is 1.25. So their taxable income in SA would be 2.5 million Rand. They don't make a 12J investment because their taxable income remains the same. The tax at the end of their financial year would be just under R1 million. The same individual, if you look at the far right column, again, 3.75 million Rand earned abroad. The exclusion applies, and their taxable income now is 2.5 million. They then make a Section 12J investment of R1 million. This now reduces their taxable income by R1 million, and they'll only have to pay tax on the 1.5 million Rand, which is just over 500,000 Rand in tax. But if you look at the tax saving, this same investor would have received a refund from SARS of 446,000 Rand, or for provisional taxpayers, which applies to expats, they would have paid less tax of 446,000 Rand to SARS. What's really a great opportunity with Section 12J is, although the investor or taxpayer would be paying 446,000 Rand less in tax, they would still be generating a return on the R1 million. From a risk capital perspective, their risk capital would be approximately 550,000 Rand. There are a couple of rules that investors must know. The first rule is that they must be invested for a minimum period of 5 years. If they withdraw the capital within the 5-year term, they would pay back all the tax benefit that they received, not pro rata based on the time that they're in, but all the tax. This unfortunately applies to financial immigration if an investor passes away during the 5-year term, or if they elect to exit. So they need to be invested for a minimum period of 5 years. I mentioned earlier there's an annual cap. Section 12J, when it was introduced in 2009, there was always an end date. And that end date is referred to as the sunset clause. The sunset clause, or the end date, comes to the end at the end of June next year. What this simply means is taxpayers have until the end of June next year to make a Section 12J investment and enjoy the tax deduction. If they invest, let's say, on the 1st of July next year, they will not be entitled to claim a tax deduction. There is, however, hope that Treasury will extend the sunset clause. We are hoping to hear within the next couple of weeks, or at the very latest in September. The industry reported results recently on the impact of Section 12J, and the numbers are actually excellent. Over 10,500 jobs have been supported. over 5.5 billion Rand has been invested into over 350 businesses at an average investment of 15 million Rand. So there is a lot of positives to be taken out of the incentive. It's definitely having a significant impact on the South African market. But the next point, and I'm going to illustrate it with some numbers, is when an investor exits the Section 12J fund, they'll be paying capital gains tax on the full value. I'd like to go in a little bit more detail because many investors, when they hear that there's CGT on exit on the entire amount, they make the assumption that the entire tax benefit is wiped out as a result of the CGT. But I'm going to show you that it's actually not. And in fact, there's an arbitrage to be made here if you just receive your capital back. So here's an example of an investor who doesn't make a Section 12J investment. They invest into a normal business. They invest 100 Rand. After 5 years, the 100 Rand has grown to 150 Rand. Their base cost, the original investment amount was 100 Rand. So as a result, the capital gain or the profit that they've made is 50 Rand. If this investor is in the highest tax bracket, they'll pay capital gains tax at a rate of 18%. So 18% of 50 Rand is 9 Rand. Their net result is that they would walk away with 141 Rand. If we now compare that to a Section 12J investment in the far right column, investor invests 100, it grows to 150. But now importantly, the base cost for capital gains tax purposes has been reduced to 0. So as a result, they'll pay capital gains on the entire 150 Rand, which if you have a look at the next column is 27 Rand, which is 18% of 150. So 150 Rand being your original, your original investment amount plus your growth minus the 27 Rand tax will bring you to 123 Rand. Now, many investors make the mistake by comparing the figures of 141 Rand to 123 Rand. They unfortunately have failed to take into consideration that this investor would have received a refund of 45 Rand upfront. So you have to add the 45 Rand to the 123 Rand, which is 168 Rand. The 45 Rand is obviously when I invest 100 Rand into a Section 12J fund, if I'm in the highest tax bracket, I receive a refund of 45% of my investment amount, which is 45 Rand in this example. So if you look at the second last line, you need to compare 168 Rand to 141 Rand on the same investment. And it's obvious, as you can see by the IRR calculation, that by investing in a Section 12J fund and doing a calculation on your risk capital, the returns are almost more than double had you invested in a Section 12J fund. So just to summarize, the tax benefit alone is 45 Rand minus your 18 Rand in tax you would have paid, which is 27 Rand. So if you just receive your capital back at the end of the 5-year term, you'd have made a guaranteed 27 Rand or 27%. As a business, we have 3 Section 12J funds. The first fund is called Infinity Anchor Fund. In my personal view, this is the best performing fund in the market by far. We've had exceptional years and we're very fortunate. This fund invests into asset rental businesses that generate income from of a contractual revenue nature. So for example, we've invested into a security rental business. This business rents out security equipment to the security industry. We recently invested in a fiber infrastructure business. This business lays or installs access points or modems in apartment blocks and then transmits the signal to people living in the estate or the apartment blocks. So instead of running a fiber cable through the building, they will Rise, which is the company, transmits the signal to the residents at a significantly lower cost. So it's very attractive. The business pre-COVID did exceptionally well. During COVID, it's done really well. And we think post-COVID, it'll continue to do really nicely. In terms of returns, last year, we had a great year. If you include the tax benefit, we had a yield of 16%. Without the tax benefit, we had a yield of 9%. We're achieving a target return of 20%. We, pre-28 or 29 February this year, invested 100% of our capital under management. We're one of the few fund managers in the market that have been able to do that. And this fund pays out dividends. Last year, we paid out 2 dividends. This year, we've already paid out 1. And it's a fund that's just continuing to do exceptionally well. Our next fund is called Zimbali Capital. This is a property-backed Section 12J fund. We've invested a significant amount of money in student accommodation. That investment has done really well. As long as students go back by February, the asset will continue to perform. We're about to invest in a lodge in Stellenbosch. The lodge comes with a guaranteed return, which includes capital growth and yield, and a dividend yield during the investment term. Last year, we had a dividend yield of 9% or 5% if you ignore the tax benefit. We're targeting a return of 18%. We've invested 100% of our investors' capital, and we paid out a dividend a couple of weeks ago. And then lastly, you may know the name Pablo Fatides. Pablo's on Cape Talk in 702 on a Thursday night, and he owns a business called Auric Business Accelerator. We partnered up with Auric to create Auric Capital, which is a private equity Section 12J fund. This fund will be investing into Auric's portfolio of clients, which consists of over 300 businesses. This is a private equity opportunity, so we'll be taking private equity stakes in these businesses. This is really for investors who are looking for a higher return, but understand the risks associated with pure private equity investments. The biggest selling factor in this fund is that we have unbelievable data on all 300 of the SMEs that we're looking to invest in. And we're running a process currently to determine which of these businesses fall within our mandate. And our mandate is really looking to invest into businesses which will give us a growth of 25% and up. Why invest with Geltec? We've really focused at deployment. We're one of the few fund managers pre-February, pre the end of February this year to have invested all our investors' capital. Many Section 12J funds are struggling to find investments. We charge a gross performance fee as opposed to a net performance fee. So if you invest 100 Rand with us and it grows to 120 Rand, we only charge a performance fee on the 20 Rand. Many Section 12J funds, if you invest 100 Rand with them and you receive 45 Rand back, they'll charge a performance fee from 55 Rand. So they take the tax benefit into account where we don't. Our funds have performed year on year. And our one fund is by far the best performing fund in the market, in my view. We're very focused on Section 12J compliance. That's a big part of our other business, and we can offer investors funding into our Section 12J investments. As I mentioned earlier, we host a webinar. It's monthly now. You're welcome to go onto our website and to register for the webinar.